Good morning, everyone. Welcome to the TradeStation Masterclass. My name is Jesus Nava. I'm the Director of Client Training and Education for TradeStation Securities. I always enjoy coming here to these sessions to talk a little bit about the TradeStation technology. Today, we're going to highlight some charting functionality that is available on the TradeStation desktop. So if you're a TradeStation client, you have access to all these chart types, and we're going to talk about the differences and the technicalities of each one of these chart-based or price-based charting so that you can start using them in your technical analysis or talk about the reasons why these types of charts exist and what are the benefits of them. So the title of today's presentation is Use Price-Based Charting to Filter Market Noise. Let's go through some of the disclosures before we get started. Keep in mind that every symbol and idea that I talk about is for educational purposes only. These are not recommendations of TradeStation, and also that active trading is not suitable for everyone. Past historical performance is no guarantee of future results. And if anybody needs a little bit more details on these disclosures, go to www.tradestation.com/important-information. All right. Thank you for joining today's class. We have a whole lineup of different topics that are upcoming. I encourage everyone to go to the TradeStation homepage, go to Learn, and there's an events link there, and you can see all the different topics that we're going to talk, about going forward. We have a series of options events that are very interesting. We're highlighting different option strategies. And if you're an options trader or have thought about trading options, these are great webinars that may benefit you. We present an idea. We show you how to apply that idea on the TradeStation platform, whether it is, analyzing the markets for uptrends or downtrends or neutral markets. So the information that is shared during those webinars, it's very useful. If you haven't seen it, just go to the tradestation.com homepage. Again, we head to the Learn section, and you're going to find options education in there. All right. Thank you guys for joining me today. Let's go ahead and get this class started and talk about charting. So let me go over here to my TradeStation platform just to get my chart set up. So let me go here and click on chart analysis. All right, let's say that we want to get started with a symbol like spider. It's already there on the screen, and this is a 5-minute chart of spider. Okay, perfect. Let me resize it. Okay, and what I'm going to do is maybe load a little bit more of additional historical data. I'm going to do 30 days. Let me disable account orders and positions. That way they're not interfering with my analysis. I'm just going to right click on one of those arrows and select disable account orders and positions. It'll clear your chart of any trading activity. And over here on the right-hand side, I'm going to open up another chart analysis. The reason for that is because I want to compare one to the other. Let me go here to the window menu and click on Arrange All. It puts those charts side by side. And they're both on spider. You can see that those two charts are exactly the same. Okay, so let's go ahead and talk a little bit about point and figure, which is, I believe, the first chart type that we have here in the PowerPoint. Point and figure. Yes, it is. And I'm just going to share that link right here in the chat window so that you have access to the PDF. All right, let's talk a little bit about point and figure. Point and figure, they filter out time and insignificant price changes, leaving a chart that contains only relevant price movements. Now, there's a couple of things here that I want to point out. Yes, it is a chart that allows you to filter out noise and insignificant price movements, but it doesn't require you as a trader to provide what the measurement would be. what you consider to be a relevant or an important or a significant price movement. Everyone here may have a different impression of what a significant price movement is based on your risk tolerance or your outlook. But yes, every price chart that you use inside of the TradeStation platform requires a little bit of subjectivity in terms of determining what is a significant price movement, what is a significant reversal from that price movement, which is one of the other components of the point and figure. And to a certain extent, you're going to have to, sit there and try to figure out what those numbers are going to be for the trading style that, for your trading style. Rising prices in a point and figure are displayed as columns of X's, and falling prices are displayed as column of O's. The box size reflects the minimum increase or decrease in price needed to add an X or an O to a column of X's or O's, respectively. The reversal amount refers to the change in price, either up or down, needed to create a new column and reverse from a column of O's to a column of X's and vice versa. We're going to drill down and take this piece by piece and try to understand, what is it that a point and figure chart is doing for us. But it's important that we have all these different annotations in the form of a PDF so that we can reference back and try to understand these chart types. We have a total of 7 different price-based charts that we're going to talk through today. They're all very similar to each other in the sense that all they care about is price movement. It doesn't really matter how long it takes or how quickly it happens. It's all about how much the price has moved. If the price moves, then the chart is going to be doing something. But if you have a neutral market where the market's not headed anywhere, a lot of these price charts will not show any movement because all they look at is movement. If there's movement, there's a chart. If there's no movement, you get a very stale chart. Let's go ahead and take a look at point and figure over here on my platform. I'm going to leave the 5-minute chart here on the left-hand side. We're going to use it as a comparison to what we're going to do here on the right-hand side with point and figure. One of the things that I look at when I'm trying to decide what a significant point movement is for the security that I'm analyzing is looking at its price and also looking at how much the price moves in general on a 5-minute time frame or in a daily time frame. I need to be able to provide those numbers to the point and figure. Of course, I can use the defaults if you want, but a lot of times, the defaults don't really fit the movement of the security that you're analyzing. This is, Spider is trading at $529 per share. It's a very, it's not a cheap stock. There are other securities that are on the cheaper side. For example, Verizon, I think it's trading at $40 or something. When you compare a $40 stock with a $500 stock, a 1-point movement means 2 totally different things. A 1-point movement on a $40 stock, it's a higher percentage movement than a 1-point movement on a $500 stock. And that's what we start thinking, okay, what is a $40? A $1 move may be significant. On Spider, maybe not that much based on percentages. Of course, if you feel like a 1-point movement on the SPY is significant and that's what you want to use as the box size, then that's up to you. One of the tools that I use on point and figure, or not on point and figure, one of the tools that I use on most of my price-based charting is ATR. I use ATR because it gives you an idea of what the average movement is on any time frame that you're analyzing. Time frame is important because on Spider, if you're looking at a 5-minute time frame, of course, it's very less likely. Let's try if that is said properly. But the chances of Spider moving a certain amount, of course, on a granular chart like a 5-minute, there are less opportunities for that to happen. If you're looking at a daily chart or a weekly chart, of course, the movement or the range of movement is going to be greater. So let's go ahead and add the point and figure here. Not the point and figure, I'm sorry. Let's go ahead and add the average true range study right here on the left-hand side. I'm going to go to add study. It's an indicator, and I'm going to go here to the A's for average true range. Here it is. And we have the indicator right there at the bottom. You can see that the very bottom, the average true range is 0.39, so almost 40 cents. Now that's an average movement per 5 minutes. 5 minutes, it moves about 40 cents. Now we can come here on the right-hand side and use that as a starting point to see what type of point and figure we get. So let me go here to data and go to edit symbol. All right, and the edit symbol dialog for this spider chart, I'm going to select point and figure. My box size, notice that it's set to 0.5 by default. Now I know that spider moves about 40 cents every 5 minutes. Of course, I can put in 40 cents. It doesn't have to be an exact science, but at least you are in the area of appropriate box size. Because let me show you something else. Let me go here to Verizon. We talked about Verizon, right? Let me switch the chart to Verizon. We can see that Verizon is trading at $39, but take a look at the ATR. The ATR is only 0.04. So if I were to set my box size on a point and figure chart here, let's go to data, edit symbol. You see, if I go back to point and figure, the default still 0.5, 50 cents. So how likely is it for Verizon to move 50 cents on a 5-minute time frame? I mean, it's gonna take some time. I mean, you can look at the scale here. You know, it goes from 39 over here, and it's 40 up here. And you can see that for the past few days, Verizon has been between 39.50 and 40. So it's about not even $1 movement has happened in the past few days. And if we set that to 0.5, then we just have to be aware of what does that represent. How long is it going to take Verizon to trade this box size of 50 cents? And considering that the average movement is 4 cents for every 5-minute bar, then that tells you something about what should be put in here into the box size, something that is a significant price movement. And again, it all depends on the time frame. I'm just looking at a 5-minute. If I were to switch this 5-minute chart to a daily, of course, Verizon has a higher average movement. You can see that it's closer to the 50 cents. So I would say that it's a little bit more in line with what the default is, which is at 0.5, right? Okay, let me go back here to Spider on a 5-minute. Give me a little bit more of historical data so that it fills the whole chart. There we go. So I'm going to come back here to the right side, go to data, edit symbol. Since this is about 40 cents, yeah, I'm going to leave it on. I'm going to go here to point and figure. As I said before, this does not have to be an exact science. It doesn't have to be, you don't have to put in there the 0.3964, but at least it gives you just an area where the box size should be. I like to set my box sizes with a number that I can calculate easy. I'm not going to do a 0.39 because if I try to calculate how many points 2 boxes or 2 X's are, it requires more math. So usually I use even numbers. Of 0.5 is a number that I would use. Maybe a 0.75, maybe just a whole point. You can just use what is best and more comfortable for you. Let me go ahead and click OK to this. And one of the things about point and figure is that it's going to try to calculate, and it's going to only load tick data. Something weird happened here, and I'm just going to explain exactly what's going on. When you set a point and figure chart on TradeStation, it's going to switch to tick data. Now, tick data by default, only loads 2 days of historical data. That is the reason why when I'm looking at a chart here on the right-hand side, and you see all the X's and boxes kind of squashed all the way to the left side of my chart, is because there's not enough historical data. It only looks at 2 days. I can force it to look more into history by providing the same historical amount that I put here on the 5-minute chart, and that was 30 days. Let me put in 30 days. Be aware, though, that when you request historical data on a point and figure chart, we are requesting tick data. And that is a massive amount of information that you're trying to download into the chart, which is okay. You just have to be aware that sometimes it may take a little bit longer than if you were just doing minute charts. Minute charts are kind of easy to load. But on a 30-day time frame, on a point and figure, let's go ahead and sit here and see how long it takes my chart to load. It also depends, on how often you've loaded tick data for that security. TradeStation has this ability to download and save historical data onto your hard drive. It makes your TradeStation load up faster. So, like for example, right now I'm loading 30 days of tick data for Spider. It's going to save it to my. And again, this may all be related to the same internet issues that I was having earlier. I don't know. It seems like after that big storm that hit Houston, okay. So my chart is still in loading data mode. Hopefully it'll load the data, and let's go ahead and take a look at what it's trying to tell us. In the meantime, you can see that on my 5-minute chart on the left-hand side, the ATR indicator and my price bars go back all the way to May 7th or May 6th. Yeah, May 6th right here. So we have May 6th to May 28th. We have about 25 days. There's more history on this chart. I can scroll back and look at. I mean, I did load 30 days of historical trading activity, and that's on my chart. But here on the right-hand side, I'm still waiting for my data. A lot of times, when you have those internet hiccups right in the middle of downloading data, that is a prime time where data really gets corrupted. Somehow, some data packages may have been downloaded incompletely, and my data may just take longer to load. So what I'm going to do, instead of sitting here and trying to see if my data got corrupted or not, I'm just going to do a Control R. Control R, what it does, if you didn't know this, hitting Control R on your keyboard, it reloads your data on the chart. So many times, especially if you're having issues downloading data onto a chart, or your data does not look the way that it should, Control R, what it does, it forces TradeStation to download the data again from the server. So it's kind of a refresh. I did it here on my TradeStation. And if I had any data on my hard drive, it actually ignores it. It just skips it altogether. It goes out to the network and it downloads fresh data. So at any moment, if you do feel that you're having some data issues, Control R usually does that for you. It refreshes the data and you can go back to the chart. I'm not sure if you guys are doing this on your side as we're going through this exercise, but if you did get a chart, let me know. You can just imagine, how long it would take. Okay, so Marcus didn't need it load for me. So my internet may be, really bad today. So I'm still waiting for the data. It's I wanted to see the date range here on the chart. If it loads, we may just leave it there open and go back to something else. In the meantime, let me see what's my next price-based chart that we have here in the PowerPoint. Renko. Renko is interesting. I've done, many strategy testing on Renko and analysis techniques from Renko. I know many TradeStation users like Renko charts. When the market moves in the same direction of the prior Renko brick by the specified brick size, a new break will be added in the same direction as the prior break. This is very similar to the point and figure. And that's one of the reasons why I always bring them up together. Renko uses a break size. And anytime that the chart moves in the direction, any direction, by the size that you specify for that break, it'll draw the direction of the prior break by twice the specified break size, and your Renko break will be added in the opposite direction of the prior break. If there's no significant change in price, the price oscillates within the range of the last break, no new break will be added. A couple of things that I wanted to point out here. Again, these are price-based charts, as the last bullet says there. If there's no price movement, the price chart will just stay there. Not like the time-based charting. In a time-based chart, you get these timestamps at the bottom of the chart, and they happen regardless whether there's little activity or a lot of activity. You always get a candlestick with that time. Not on price-based charting. You only get a candlestick if there is price movement. Let me go back here to my TradeStation. Still loading. Sorry about that. But one of the things that are different about Renko when compared to point and figure is that point and figure, you can adjust what the reversal amount is. I'm not sure if you noticed here, but the Renko chart is looking for twice the reversal amount. So I have a picture of Renko right here on the left-hand side. These Renko boxes that are green are being drawn because the price is going up. If the price eventually comes down, it would have to come down the length of that green box and then another one, so that it knows that it has to switch over to a sequence of red boxes showing that reversal. Okay, there we go. My point and figure loaded. Now you can see that on my point and figure, the time scale right here at the bottom goes further back. I'm going to increase my spacing by hitting the up arrow key so that I can see my time scale kind of match my scale here on the left-hand side. Let's see. Okay, so this is perfect. This is May 7th. What's the prior one? This is May 2nd, May 3rd, May 3rd, May 7th. Okay. Okay, so by looking at the two charts here, we have similar time frame. We can remove the ATR here from the bottom so we can see what has been happening. You can see that from May 7th, we have experienced some sort of an upswing. Everybody sees the up bars right here. Now, during this upswing, there's been some noise. There's been a lot of ups and downs. And, you get, if you, let me zoom in. Here we go. So in this upswing, there's always going to be small corrections. The price is moving up, then it corrects a little bit, and then it moves up again. Then the price continues to go up, then we have a small correction, and it continues to go up. Those small corrections are what we considered, or what we call, market noise. And the price-based charting, what they do is that they remove it. They remove it because it doesn't quite meet your description of what it would be a significant price movement or a significant reversal. But let me zoom out here for a bit and show you what I mean by that. So on this area from 5.7 to 5, let's say 5.8, we have an upswing. This is 5.8 right here. It got to a point that the price dropped enough for the point and figure to consider it a significant reversal. And that's exactly what happened here in this column of O's. We see that drop, but it only shows you that significant drop. What happened to all the other ones that happened before this significant one? They're filtered out. For what the point and figure is doing, it just sees the uptrending market and it just removes all those small corrections. As you can see, just this big column of X's representative of that upswing. The market continued to go up again. And it wasn't until this day right here, May 10th, when we have a significant drop again. So this is the May 10th drop that you see right there. But you can see how simple the price representation is on a point and figure. If the price moves enough, then it'll reverse. But if it doesn't move enough, then it'll just continue adding boxes or X's in the direction that the market's moving. So all this information that you see here, all this little ups and downs is represented by just this right here on my point and figure. Right now, let me open this up. You can see that I am currently in a column of O's. So if I open up my chart here of Spider, yeah, it seems like I'm not really sure when this happened exactly. I can look at the date here. This is the 28th, the 28th, the 24th. So there was a price movement. This is the 24th too. So this upswing right here is represented by this upward movement. There's been a little bit of ups and downs for Spider for the past day or two. It's represented here as well. But you can see two lines that are important on the point and figure. You see the red line, which is an arrow pointing towards the column. That is where the current price is 529.83. But it's also important, this little green line at the very top, that is your reversal line, which means that if the price were to reach that level, it'll turn your point and figure chart into a column of X's, because that's where the reversal amount is. Now, where is the reversal amount specified in a point and figure? If you go to data and edit symbol, it's going to be right here. That's the reversal amount. And it's a factor. Whatever number you put in there is going to be multiplied by the box size. So what we wanted for Spider is a reversal amount of $1.50. If we multiply the $3 times the 0.5, we get $1.50. Let me go ahead and cancel out of this. So this little green line is going to be $1.50 away from the bottom of this column of O's. The column of O's is building towards the bottom, right? But you can see that the price has been going up, and if it hits that reversal, it's going to switch over to a column of X's. If it drops all of a sudden, and it goes lower than this level, it's just going to continue to add red O's onto my point and figure. But for now, it just seems like it's pointing upward, and it's very close to hitting my reversal. When it does, it's just going to draw 3 X's automatically. Why 3 X's? Because 3 X's is what your reversal amount is, 3 times your box size. And if every X is a 0.5, then as soon as it hits the reversal, you're going to see 3 X's plotted because it moved that amount in the opposite direction. Does that make sense? So yes, keep in mind that there's a couple of things that you have to specify for the point and figure: your box size and your reversal. What you consider to be significant movement for the box size, and also what you consider to be a significant movement to actually come to a realization that the market has reversed and that it should be plotted on the chart. On a Renko chart, let me go back here to a Renko. Renko is very similar. We talked about it. So let's go ahead and compare Renko with point and figure. Again, you're not going to have a reversal box for you to specify what the amount is, because it just looks at the number. It just looks at the boxes that are drawn. So it just keeps on adding boxes if it's in the same direction. And if it goes in the opposite direction by at least 2 of those boxes, that's when it reverses. Let's go back here to my chart. Let me go to data, edit symbol. Let's say that we want to build a Renko chart right here. I'm going to do a classic. That's the one that it's commonly used. We have other variations like the mean and custom, which just the mean and the custom, the only thing that they do is like they shift the boxes alignment if you want to. The classic just stacks the boxes on top of each other. I'm going to use the same brick size, which is the one we used on the point and figure. But let me go ahead and load 30 days back. All right, this may take a little bit long, although it did download the tick data onto my computer, so it shouldn't take as long as the point and figure did. You can see how the chart came back much faster. Let me squeeze the chart again so that I can see 5-7 down here. Okay. Now the movement, let me squeeze the chart as well. The movement that you saw on the point and figure, it's very similar to this one, right? We have that big upswing, then we have a little bit of corrections. But it's in my opinion, it's kind of a cleaner view because you don't have these triple X's. Well, if the reversal is 3, of course, but you have these triple X's and triple O's kind of stacked against each other. Here, you have these peaks and troughs that are created by those reversals. What I mean by that, let's go ahead and open this up a little bit. Right here, we have a fixed green box, and the green little dash on the right-hand side is just telling you where the current price is. Now, that current price is moving up and down on the side of that brick. As soon as it starts moving higher than the top of the prior box, you'll see the little brick start to extend. And it happens, visually on this chart, and it's pretty cool. Now, if the line were to drop below the low of that other box, you'll see the red box starting to extend. But it's not until the full size of the brick is achieved that the box will be set on the chart. See, right now, we're almost hitting that low mark. I just wanted to hit it a little bit so that we can see how it looks as it's building. But other things that I wanted to show you here on the Renko is the mean. The mean just means that it's just going to shift those boxes a little bit for you. Let me see if it comes back. But instead of stacking the boxes on top of each other like it does by default, you'll see a little bit of a shift on the boxes. Yeah, here we go. So the boxes, instead of being stacked on top, is actually, kind of shifted to the middle of the prior box. And you have some wicks here letting you know, or letting you see where the price has been. That's something you don't see on the classic. Here, on the classic, you just see the dash, pointing towards the box, and you can see where the current price is. But right now, you can see the extent of where the price has been throughout the building of these boxes, okay? Perfect. Many, if not all, of the indicators and strategies that you would use on a regular chart also work here as well. Okay, so Kagi. Kagi displays a series of connecting vertical lines whose thickness and direction are dependent on price direction. When the market moves in the same direction as the prior Kagi line, the line will extend. When the market moves in the opposite direction by at least a reversal amount, a new Kagi line in the opposite direction will be displayed. I think, out of all the price-based charts, this is the one that is a little tricky to understand. So let's go ahead and take a look at the line on the chart. And I think once we have a visual, it'll be easier to understand. Let's go here to data, edit symbol. We'll go to Kagi. Reversal, what we're looking for here is the reversal, and it says a 0.5. Let me set it to a 1 as a reversal using tick data. And I'm going to load 30 days. So it does take a look at all the pricing activity of those 30 days and starts building this line based on the price movements. Of course, if the prices are going up, the line is pointing upward. And if the prices are going down, the line is pointing or drawing downward. Right now, the line, you can see that it's extending upward. So it's kind of extending upward. You see the arrow pointing towards the left. That's where the current price is. And then you have the reversal. The reversal is going to be 1 point, because that's what we specified, right? 1 point from the peak of that line. Let me see what that peak of that line is. You can see the high is 530.16. So the reversal is going to be at 529.16, 1 point lower. If the price activity drops and touches that, what happens to the line? Well, the line, instead of continuing to extend upward, it'll reverse. It'll have this kind of action where it flats at the top and then it starts pointing downward because it hits the reversal. It doesn't quite change the color yet because the color is based on something different. The color is based on when it passes or surpasses a prior high or a prior low. See, right now we are on a green line. In order for this green line to turn red, it would have, well, first it will have to turn around, and then it would have to be lower than the prior low. And you can see that on historical times, that's where the prices, that's where the color switches. You can see here, for example, that we were on a green line, and all of a sudden, when we crossed the bottom of a prior Kagi line, that's when the line switches color. So now we are on a red extending line here, and it remains red until we cross the higher high. Does that make sense? So it's a very interesting way of looking at a chart. Of course, it has some of the same concepts that we see in point and figure and Renko, where you have a size and you have a reversal amount. In this case, we only specify the reversal amount. The next three charts, range, momentum, and case. I talk about those together because they are very similar on what they do. And what they do is they have a target range that they're shooting for, and when it finds it, then it goes on to the next candle. Let's go ahead and take a look. And I'll see what the differences are between the three, but they are going to be very similar. Let me go here to data, edit symbol, range. You can see range, you have to specify a range. If you go to momentum, you still have to specify a range. And if you go to case, you still have to specify a range. So all three require for you to specify what the range is going to be. And range in analysis terms is just how big the candles are, the difference between the high and the low, and you're shooting for that target, and you want every candle to have that target. Let me go here to range, set it to 1 point, and 1 tick is fine. I'm going to do 30 days. Let's see. Okay, there we go. On a range bar, the difference between the high and the low on every single candle is going to be 1 point, because that's what we set it to. Let's grab this this candle with a big tail. If I click it, you can see how the high is 529.28 and the low is 528.28. Exactly 1 point. And if you go candle to candle, you're going to get exactly that difference. The only candle that is not going to have the 1 point is the one that's building at the moment. Why? Because it has to meet that 1 point in range. What's the range on that last bar? The high here is 530.16 and the low is 529.36. So we're talking about 80 cents, right? 80 cents in range. And it's not until it hits that 1 point range that it goes on to the next candle. Now that could take days, weeks, years. If the price is not moving, it will not draw another candle. Now, if the price moves significantly, then you'll have more activity on the chart. It's sensitive to price movement. Let me go ahead and squeeze the chart so I can see 5-7 in here. So we have a comparable chart. You can see that it still filters some of the noise out, not as much as the other ones, you know, as a Renko. Filtering out noise may be, depending on how you look at it, maybe a good thing or it may be a bad thing, you know, because you're not really reacting to those small movements that could be, you know, good trading opportunities. However, let's talk about, one thing that I wanted to point out is exactly what happened here. You see, there's a gap that happened between May 14th and May 15th. Everybody sees the gap? You don't see the gap right here. What the range chart does is it fills the gap in, meaning that if there was a price jump, you know, from here, from this low to this high, if there was a price jump, that is still considered a price movement and is going to graphically represent that with candlesticks, even though there wasn't really any trading activity in between because there was a gap. But in terms of price movement, it actually did move through that. And that's why range is filling in the gap with bars. We call them synthetic bars, where no real trading activity has happened, but the price did move. Difference between range and momentum. Slight difference. And if we're not really careful, we may miss the slight difference. Momentum, as the name implies, is looking for a little bit of movement from one bar to the next. What does that mean? It means that, going back here to my candle at the very end that does not have the 1 point range, when the candle meets the range of 1 point, range will automatically close it and start the new one. And that's the reason why the open and the close that you see from candle to candle are going to be exactly the same. Let me demonstrate. What's the closing price here? 529.27. Keep that in mind, 529.27. What's the opening price of the next bar? The opening price, 529.27. What's the closing price of this one? 530. What is the opening price of the next one? 530. So one closes, the other one opens at exactly the same tick. That's range. Momentum is looking for an additional tick that exceeds the range. And that's why in a momentum chart, there's always going to be one tick difference between the open and the close. That's it. That's the only difference between a range and a momentum chart. Let me go here to data, edit symbol. Momentum, same range. I'm going to do 30 days back. The charts are going to look very identical because graphically, you can't really tell a difference if the opening and the closing price are one tick apart. But let's go ahead and take a look. The close here, 527.27, 529.27. That's the one we looked at earlier. What's the opening on the next bar? 529.26. One tick lower. Why did it open one tick lower? Because we were in a down candle and it exceeded the range to the downside. That's the opening is 526, 529.26. What's the closing price here? The closing on this candle is 530. The opening of the next one should be 530.01. Is it? What's the opening here? 530.01. See the tick difference between the opening and the close. That's the only difference between momentum and range. Let's take a look at the third one, which is very similar to these two, which is case. Case has a target range. Let me do 30 days back. The difference between case, momentum, and range is that case uses real data. Let's go ahead and take a look. Sorry about that. So let's go here. My daughter just came in and distracted me. Sorry about that. She wanted to play, yes. Out of all times right now. So let's go here and Okay, so this is case. Case, the difference is that it uses real trading activity. So again, take a look at the gap. Remember when we were looking at momentum that the gap would get filled based on the price movement? Not in case. In a case chart, it only uses real tick data. So if there's no trade activity, it won't show it. You won't get these synthetic bars that you would find on range and momentum. There's some users like that because they don't confuse gaps with real trading activity. You actually see the gaps within the price bars. There's some other differences here. For example, sometimes you'll see that the range is not exactly 1 point. Let's look at an example here. So let's take a look at this one. The close here is high to low, 530.10, and the low is 529.10. This is exactly 1 point. This is exactly 1 point. High low. This is not 1 point. Take a look at this one right here. This is it happened recently. This is a bar from today, but you can see how the high is 530.50 and the low is 530.10. What happened there? There's only 40 cents in range. Why didn't it continue? The reason for that is because a lot of times there's going to be huge trades that come in the trading activity that case does not split up. Range and momentum don't really care about how big the trades are. What it'll do, it'll just look at the price, split the price in between, and then move over to the next bar and kind of leave that trade hanging between two candlesticks, you know? Because if you think about it, if you have a large trade that meets the range, of course, it has to make a decision as to, okay, where do I put that trade? Do I put it here on this bar or this other bar? What case does is that it makes that decision based on range and based on behavior. But a lot of times, like on this particular example, the trade that exceeded the range was not put into that same bar. It was actually put over onto the next one. So the next one has a range of exactly 1 point. Okay, so those are some of the things that, of course, I'm just simplifying the way that case does it. There's a lot more technicalities and a lot of more formulas that go into how does it determine which trade to put into which candlestick. But one thing it won't do is split a trade into something that range and momentum do all the time. Okay, so case, and I think this is the last one, line break chart. Yes, line break chart is interesting. Okay, we're almost running it. We're running out of time. The line break chart is made up of a series of vertical blocks called lines. Line break charts are most commonly set to 3 and are known as 3-line break charts. A break of the lowest low of the last 3 ups will be generated down line, and a break of the highest high of the last 3 down lines will generate an up line. Let's go ahead and take a look at that on the chart because it makes so much more sense once you have a visual. Let me go here to data, edit symbol. We call that a line break. You can specify how many lines it needs to break in order to switch. I'm going to leave it at 1. I'm going to leave it at 3, which is the default. And I'm just going to load more historical data. So this is an interesting way of looking at a chart because it creates sort of similar lines, like the Kagi line, very similar. But in this case, these are like kind of blocks that extend up or down. And what it's doing, if the price is heading in the same direction, it'll just continue to extend that price. And there's a time component here. But over here, in order for you to switch from a column of greens to a column of reds, it has to go lower than the prior 3 boxes. So it counts 1, 2, and 3. So as soon as the price went lower than this, it turned red. Does that make sense? And then as soon as it went lower than the prior one, then it's red again. So it continues to go red and red and red. Everybody sees this green box building at the moment. That's because it's moving in the opposite direction, but it's not a fixed green. I'm not sure if you can tell the difference in green, but this green is kind of a lighter shade of green. In order for this green to be fixed, it has to be the next one. Makes sense? If the price, you see right now, see how the price dropped, now it's going to continue to extend in the same direction of where it's headed or not. It's just going to fluctuate there. But it's not until it hits, right now we have more of those down bars. But you can see how this is building based on that constant. Price moving in the same direction will continue to extend. But if it moves in the opposite direction, it has to cross at least 3 of the prior boxes, highs or lows. Heikin-Ashi is a different calculation altogether. It's not only based on price. I believe there's other calculations. I'm not really familiar with the details on how the calculation happens. We don't have Heikin-Ashi at the moment. However, there are some custom studies out there that provide you the functionality. Let me just see if I have it here on the screen. Studies. I think it was a subject of one of our master classes, if I'm not mistaken. And if not, maybe not. I have one here called Heikin-Ashi, but it's not verified. I'm not sure why it is not. But yeah, Heikin-Ashi is not one of the built-in, charting that we have available on TradeStation. Many users have asked for it. Eventually, we'll have it. I think TradeStation is considering adding it to the default types of charts that we have available. However, there is a forum on the TradeStation discussion forums. There is a post that provides you code for the Heikin-Ashi candles if you want to bring them over to your TradeStation. All right. Well, that's my class for today. Let me not take more of your time. I want to appreciate the time that you spent here with me. We do all these master classes every Tuesday at 11 a.m. Please bring your questions, for your ideas. Tomorrow, we're going to do a getting started session. So make sure that you register for that one. But again, look at our events calendar for upcoming sessions. And I want to wish everyone here a happy Tuesday. And I hope that everyone had a wonderful weekend. Have a great day. Bye-bye. Great having you.